Ho, 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 what do you know? I'm back in the Midwest, or at least I think this is the Midwest. Is Oklahoma City considered the Midwest, guys? You let me know in the comments. I feel like it is driving in here. It is just flat as a board driving in, nothing but farms and cows everywhere, so it reminds me a lot of Illinois where I grew up, so I would consider it the Midwest, although Texas kind of feels like that too. So today, I figured I'd do something different, bring you guys to downtown Oklahoma City, and we haven't really visited any of the downtown centers of any of the places that I have been to yet. So I figured let's just change it up. Let's get out of the neighborhood for the day and come down to one of the city centers and see what it's like over here. Now today we have some huge news regarding the housing market because the amount of foreclosures is starting to build up and mount, and it is now past where it was pre-pandemic. And this is a huge deal, guys, because so many people have been thinking for the past few years that nothing bad is going to happen in this market because so many people locked in the low rates. Like, that seems to be like the huge narrative that just makes it sound like nobody can ever have a hiccup or a default in life because people locked in the low rates. Well, that's definitely not going to be enough. Now listen to this. Foreclosure filings, which include default notices, scheduled auctions, and bank repossessions, jumped 28% in the third quarter of 2023 from the prior quarter to 125,000 basically. That's a lot of foreclosures, guys. Now, not every single one of those will end up in foreclosure and actually on the chopping block where you can actually go out and buy it, but the vast majority of them will. And not only is it up 28% from the previous quarter, but it's up 34% from 1 year ago. Just in September alone, we saw an 11% jump in foreclosure filings, which is up to 38,000 in just 1 month. And that's up 18% from September of 2022. And right now, lenders are actively moving forward with the foreclosure process on about 69,000 properties in the US just over the past quarter. And that's also up 3% from the third quarter of 2022, basically a year ago. So if you don't think this is happening, guys, time to wake up. Foreclosures are going to be hitting the chopping block within the next couple of years, and some of them may be faster because some states are very quick at doing foreclosures while others are very slow at it. So it just kind of depends on how fast you're going to see foreclosures hit the market in your local area, but rest assured they are coming. And part of this is due to the fact that forbearance programs that we saw during the pandemic are over. Okay, everything from the pandemic is over, and we're starting to have to wake up and get back to reality here because so many things were put into place during that time period that made us live in la-la land, you know? Oh, you don't have to pay the rent. Oh, you don't have to pay the mortgage. Oh, here's free money for you. Oh, you can go ahead and just live there for free. You're not going to get evicted. All these things that we saw happen, those things are over. And now it's time to pay the piper. Here's the reality, guys. A lot of these households that received this sort of assistance were already in trouble before the pandemic, which is why they needed forbearance. You know, that's why they needed to get into these programs because they were already struggling, and then the pandemic was just kind of like the final killing blow. But now that all of these subsidies and assistance programs are over with, those people are finally having to pay the bills. Well, it looks like the LA and San Francisco problem is even hitting Oklahoma City, folks. Get ready, the epidemic's coming everywhere. And here's the other thing. We keep hearing all this news about the soft landing, just like I covered. That's the Fed's prediction of where the economy is going. Looks like that's not going to be the case, guys, especially with real estate, because you would not be seeing this level of foreclosures right now if things were so great in this economy. This is really bad news, and it's probably only going to continue to get worse because as the economy gets worse, you're going to see more layoffs and less people able to pay their mortgage. I've never been here before, guys, but this would be one of the last places I would imagine you would see homeless people hanging around what appears to be like some sort of federal or city building. And yeah, looks like it's starting to spread. It's not just California anymore. Wow, it's a lot crazier down here than I thought it would be. Now, this is just the beginning with the foreclosures, guys, and you know why? Because there's so many things that are hitting us right now. Like I discussed in yesterday's video, people are starting to run out of money when it comes to the pandemic savings. Credit cards are being maxed out to all-time highs. You have home equity loans that are up to the highest levels that we've seen in 15 years. Now, to top it all off, we have the resumption of the student loan payments, which is extra money that people also had for a long time that they're no longer going to have. And if you're going to sit there and tell me that this isn't going to have an impact on people being able to pay bills, I'm just totally in disagreement on that, because we're already starting to see the strain. And in fact, it's been building for a long time, because these foreclosures don't just start overnight, guys. People don't get foreclosure notices, or they don't start proceedings until after 90 days delinquency. So what were you doing 90 days ago? Oh, that was like summertime, happy-go-lucky, everybody was having money, everybody was out spending. Well, what about now? They've been talking to people with student loans, and apparently 34% of student loan borrowers right now say that they can't afford to make their payments at all. So that means when they get the first bill in the mail, which was already probably a couple of weeks ago in October, they're not gonna be able to pay it, guys. So what are people like that going to do? They're gonna have to decide which bills to pay. Now, I do think that most people, when pushed against the wall like this, they'll likely choose to skip out on paying a lot of other bills, like a credit card bill or a car loan or anything like that, before they skip out on their mortgage, because obviously that's the last thing people want to lose. People need to have a place to live. And in case you can't tell, yeah, it's windy here again, just like Texas. It's pretty annoying, but it is what it is. So once again, people that have been betting on the fact that we're going to have low inventory forever, guys, don't count on it. The tables are turning. And I guarantee you, a lot of people, before they go into foreclosure, will likely try to sell their house, because why wouldn't you? Why wouldn't you try to sell your house if you still have equity, but you just can't pay the bills, especially getting ahead of it right now while it's still a relatively low inventory situation? It makes sense. So people that cannot pay will likely sell, and if they can't sell, then go into foreclosure. And this is just the beginning. This is just the beginning of defaults. This is just the beginning of more inventory hitting the market over the next couple of years. Right over by downtown here, they have this cool little park that has like a botanical garden and all sorts of other things in here, so let's go check it out. Now, if you think that this is all made up, guys, first of all, this is coming from data from the real estate firm ATTOM, ATTOM. They are a real estate data firm, and they collect all different types of data about the housing market, and that's where this is from. To kind of reinforce this idea, I've been getting these emails all summer long. I shared one with you guys, I don't know, a couple of months ago, but now here's another one. Check out what it says. When I first started in real estate, I signed up to be on notice to potentially get foreclosure listings, because when I started in 2009, there were a ton of foreclosures. Well, check out the email I just got today. Local agent foreclosure default forecast for the month of October 2023. There is an absolute tidal wave of default notices coming to your local real estate market in fall 2023. This is mostly due to unprecedented amount of homes that had been in forbearance and government stimulus programs, which had only provided a temporary band-aid to your local real estate market. Now lenders want their money. Find out how agents in your local market are protecting themselves for the inevitable market downturn. Protect yourself and your business by working with asset managers and banks to list notice of default homes in your county. Now, this is a real thing, guys. This is something that you can really sign up for as a real estate agent, and it's a good way to make money in a bad economy. In fact, when I first started as an agent, the housing market was in complete free-for-all. It was the beginning of 2009, and what happened back then was every Tuesday, my office used to have a meeting. And that's where I got this information from back then. They would give us ways to get these foreclosure listings, figure out how to get short sale listings, and thrive in an otherwise pretty bad economic situation. And that's exactly what I did, and many other people who survived that housing crash did. And this is happening all over again. Now, is this gonna be as bad as 2008? Who knows, guys? So far, it doesn't look like it. As far as at least the amount of foreclosures that we're seeing, it's nowhere near the amount that we saw back then. But we're starting to see the pressure build up. And since I keep saying, and you keep hearing other people say, this is just the beginning of what's going to be this economic downturn, we don't know how much worse it's going to get from here on out. This is actually pretty cool. They have this whole little fall event going on over here, like a little pumpkin patch thing going on for the kids, different things like that. pretty neat. Now, even with all this information coming out on these default notices, Goldman Sachs just came out and said that home prices are going to continue to go up throughout the rest of the year. Do you believe that? Well, I don't, because home prices have already been going down since the end of summer, and they're likely to continue to go down throughout fall and winter. That's what happens every year, and it's a seasonal trend. Now, one thing that they do admit is that the affordability crisis that we're in when it comes to real estate is much worse than it was in 2008. Here's what they're saying. Absent any negative shocks to the broader economy that would either boost excess supply of homes on the market or fuel an uptick in unemployment, we continue to expect to see home prices rise at a slow pace. Interesting. Well, I think we're already starting to see those cracks form in the economy in the form of inflation not going away, in the form of unemployment starting to tick back up a little bit, and in the form of all these foreclosures starting to come, guys. Is that not economic distress? Is that not? Tell me that's not economic distress, because it is. But despite all this, they're saying that by the end of this year, we'll see home prices rise by 1.8% with a 3.5% increase by the end of 2024. So they're thinking in a year from now, the housing market is going to be in an even better situation than it is today. Good luck with that prediction, guys. I can't wait to dig back into that one in a year from now. Now, here's one area of their prediction that they're just flat out wrong, or they just are completely unaware of what's going on. They're talking about how 2 decades ago, we saw 0 down payment mortgages and people taking cash out in the form of home equity loans for people to boost their money supply. That sounds exactly like what's happening right now. They're saying there's no 0% down mortgages. Give me a break, guys. You might not have 0% down mortgages, but it's pretty close. You have United Wholesale Mortgage doing 1% down. You have Rocket Mortgage doing 1% down. You have Zillow Mortgage now doing 1% down. So that's basically like a 0% down loan. And on top of that, they'll subsidize part of your down payment from there. So it's almost the same thing. I don't see really the difference at all. They're saying another reason we're not going to see a 2008 style crash is because back then the supply was much higher, and also there was a buildup in shadow inventory. There were many borrowers facing foreclosure even before the job losses started. That sounds exactly like what we just talked about. Now, I will say that we are in a much lower inventory situation currently than we were before the housing market started to collapse back in 2008. We just had a higher level of inventory back then across the board, and then we saw these defaults on top of it, which is part of what made it so bad. So there's a possibility that this time around might not be as bad. But like I said, since we're just getting into this economic downturn and the recession hasn't even officially begun, we don't really know how bad it could get from here. And talk about shadow inventory, what about the email I just shared with you guys a little bit ago, trying to recruit agents to take on REO listings? That's shadow inventory right there building up. You have lots of defaults in the background in foreclosures and lenders gearing up to handle this essentially because they need to have staff, guys. You can't just have a wave of defaults and foreclosures coming in and nobody to be able to market them and sell them and perform broker price opinions and everything that's involved with making sure these transactions can get pushed through. Because the last thing the bank wants, they don't want to hang on to a property. Once they officially take possession of that property, they want to sell it as fast as possible, because every single month that they hang on to it, just like you, they're losing money. They're paying the property taxes, they're paying the insurance, they're paying any sort of maintenance or upkeep or utilities that need to be turned on. They're paying for everything, waiting for somebody to come along and buy it. And they don't want that. Now, one thing I actually agree with that Goldman Sachs said is that, unfortunately, for buyers, don't expect deals anytime soon, especially without a boost in supply or a drop in mortgage rates or an uptick in unemployment. Now, I agree with that only because in the near term, meaning in the next, say, like 3 to 6 months, you're not going to likely see these numbers change dramatically unless something all out crazy happens. Like now we're seeing these wars, we're seeing different horrible things happen, and oil prices start to spike. That can definitely have an impact on how fast all of this can start tumbling down. But over the long term, meaning within the next 3 to 5 years, I expect to see a lot of problems with this. So if you're a home buyer, don't think you're going to be getting 20% off the house tomorrow, but maybe in a year or two from now, that can be a definite possibility with the way things are going. And right now, you also have home builder stocks that are absolutely tanking, because as these mortgage rates continue to climb, the demand for new home buyers is also plummeting along with it. And this is a big surprise, mainly because new home buyers have been crushing it. They have been out in this market, they have been buying up everything because the home builders have been giving them such a great deal. And even though they've been buying as much as they can, there's still like a 6-7 month supply of new homes on the market right now. You have mortgage rates at a 23-year high at the moment. The iShares Home Construction ETF, that just dropped by 5.2%. And that's the biggest one-day drop that they have seen in the last 13 months. And then you have bigger home builders like D.R. Horton. Their stock went down 6.3% to a 6-month low. Lennar, they went down 5.7%. Toll Brothers, they're down 6.7%. Pulte Group, they're down 5.9%. And even Home Depot is down 2.4% right now. So what you're starting to witness with this, I believe, is a slow motion collapse of the real estate market, because everything seems to be happening at the same time. When you take away the demand for housing, guys, due to high interest rates, you know, that's going to kill everything. It's going to kill the remodeling business. It's going to kill new home sales. It's going to kill existing home sales. And we're starting to see it all happen now in real time with these stats. This is such a cool area, man. I've never been to anything like this before, and I'm really glad I came down here. I don't know, what do you guys think? This is just an awesome little botanical garden area. I think it's even free to go inside, but it's such a beautiful day. I wanted to just spend time out here. Now, what about Oklahoma City, where we're walking right now? What's the state of affairs with the market here? Well, let's take a look. This is actually the first market that we've been to on this road trip that's actually starting to go negative year over year. Now, it's not down by much. It's only by 0.39% negative year over year as of the most recent Redfin data. And here's the thing, guys, even though this is still an extremely affordable market with a median home price of $255,000, the real problem is that even though that's still affordable on a national scale, the home prices here absolutely skyrocketed. In October 2019, just 4 years ago, the median home price here was 183 grand. Another thing you're starting to see here is that the home sales are also down by 20% year over year. The reason why that's crazy is because here in Oklahoma City, actually, it's still affordable for the locals to buy even at these prices, okay? When you look at the home payments as a percentage of median income, it's still 29%, guys. That's still definitely in the range of what everybody would consider to be affordable, and mortgage lenders will have no problem writing you a loan with that debt to income ratio. So even at this $255,000 price point, people that live here can still afford to buy, but yet home sales are still down by 20%. Why is that? What's going on? So I don't know this area well. I've never even been here before. It's my first time in Oklahoma ever, but my guess at what's going on by looking at these market stats is a couple of things. Number one, people are waking up to the fact that this is not a good time to buy, because they saw home prices here shoot up by $70,000 over the past 4 years. And that, even though that might not sound like a lot to you, I'm sure it's a lot for the people that live here. The other thing is I don't know what the employment situation is here. I don't know how many people have been losing jobs and can't buy even if they wanted to. Hi. Yeah, say hello to everybody. Happy Halloween. It's called Michael Bordenero.
Yeah.
Check it out.
Yeah.
So this is so cool, guys. I love this. You know, the kids here are so friendly. You saw them in the video here. I mean, people here are really nice. It's nice to be back in a nice Midwestern city and get that Midwestern charm. You know, that's one thing I definitely miss about being in this area in general, is just the politeness and friendliness of people is second to none. Now, one last thing I wanted to cover here, which is kind of like a question that came up, not for me, but it's like a real estate question that came up that I saw in our real estate newsletter. And it basically is it legitimate and legal for a landlord to require rent to be paid in cash? And the short answer is yes, it is legal. And basically, because a lease is a contract, and a landlord and tenant can agree to the form of payment within the contract. As long as it's in the contract, it's definitely something that can be required. And obviously you want to get a receipt every time. In fact, I used to have a landlord that would actually come and pick up the rent from me every single month in person. He would show up on the 1st at the door, and I would hand him either cash or a check, and he would give me a receipt. And it's so important to at least keep those records if you're going to actually pay in cash, because you want to make sure you have proof of payment, guys. Because the last thing you want is the landlord coming to collect the cash, and then 6 months later they say, oh, you haven't been paying the rent, and you don't have any receipts to prove that you have been. So that's not a good situation to be in. And the other thing is, if you're going to pay rent in cash, you need to confirm 100% that the person you're paying the rent to is in fact the landlord, because if they're not, you could be being scammed. It's kind of an unconventional thing to require the rent to be paid in cash. Like, it's not very standard for that to be the case, but some landlords are crazy and they want the cash. But one thing's for sure is that if something feels off with the situation, your gut is telling you something's just not right with this, then maybe it's good to walk away from that particular lease. Because if you feel like you can't confirm it's actually the landlord, or they don't seem very trustworthy, or they're reluctant to give you a receipt for paying the cash, then that's a huge red flag. It's better to look elsewhere. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.